Hi, Jonathan York from IRG BOP. Looking at what's the events over the last week or so in the market and how we're trying to separate the hype from the actual facts that are taking place in the global markets. Obviously, the economic situation has been dominated by what may or may not happen in the Eurozone and the failure of the Eurozone members to come up with a suitable rescue package for not just the Greek sovereign debt, but the Eurozone in general. That saw a major sell-off towards the end of last week, which was then exaggerated by the so-called fat finger trade in the US, where the Dow Jones fell by nearly 1,000 points in the space of about 30-odd minutes. If you fast forward a couple of days now, what's happened over the weekend is that the Eurozone have come out with a pretty much a shock and awe rescue package similar to that which was announced by the US Fed some 18 months ago, where they look to guarantee debt, provide liquidity, and really to shore up the markets and show the markets that they are prepared to do pretty much whatever it takes to get stability back into the marketplace. This has seen a major rally on global share markets and also the currency markets as well. So now going forward, what this does, it just gives the Eurozone a little bit of time to be able to work through the issues that is are currently affecting their economy. And if you compare that with the US, on Australia and New Zealand, the US has been through this situation, is now starting to emerge from the other side, and many of the programs and the rescue packages that were put in place have actually been removed or wound down without the market coming into any undue jitters about it. The recent data coming out of the US for the last 2 months now, we've seen approximately 450,000 new jobs created within the economy. Now that's not a lot given the overall size of the economy, but it does show we're on the right path, and you're seeing growth coming forward. And saying that is being backed up by the latest earnings data coming out of the US as well. Most of the S&P 500 companies produced better than expected earnings, and that is expected to continue over the next 2 to 3 quarters. In New Zealand, we saw a very encouraging unemployment data as well, a big drop there, one of the biggest drops there in the last few years, and that now has heightened expectations that the Reserve Bank will now increase rates here in June. Before the unemployment data, we'd be looking at probably September before the first rate increase. So now we expect one in June and possibly one further before the end of the September quarter. That will put us on the road to getting back to a market neutral rate. But as stated previously, the Reserve Bank now anticipates that the actual high of the interest rate cycle will be somewhat lower than in previous cycles. In terms of how we take advantage of these, obviously global equity markets do still appear to be there to be purchased. We have several offerings in the marketplace that enable you to do that. If you're looking at capital protection, you've got the Lion Tamer Global Series 7 out there, which is a 6-year product, capital protected if held to maturity. Given the strength of the New Zealand dollar against the British pound, many of the UK shares are looking quite attractive. We mentioned previously about the BlackRock Global Mining Index. Still like that as an individual share. Looks at obviously the mining sector, the minerals out of Australia and South America. Still looking at that as a pretty decent investment opportunity for global growth. If you're interested in any of these options or looking just to discuss your portfolio, call us on 0800 867 333 or go to the website www.irgbop.co.nz. Lots of interesting articles, disclosure statement available on request, and we look forward to speaking to you soon. Thank you. Different sort of investment